Commissioners for Her Majesty's Revenue and Customs, Appellant, and NCL Investments Ltd and another Respondents.
Lady Rose will explain the decision of the Court.
This appeal concerns the proper treatment for corporation tax purposes of accounting debits which were included in the financial accounts of the two respondent companies. Those companies are NCL Investments Ltd and Smith Williamson Holdings Ltd, which I will refer to as the company. The companies were owned by a parent company, which I'll call the holding company. The companies granted to their employees share options in the holding company as part of their remuneration package. The employees, if they met the eligibility criteria when the options matured, could decide whether to exercise the options by buying shares in the holding company. The share options were granted to the employees by the trustees of an employee benefit trust, which had been set up by the holding company. This kind of share option scheme is popular with companies because it incentivizes employees to work hard by giving them a small stake in the future success of the business. The correct approach in law to the circumstances in which a company can deduct this kind of expense and thereby reduce the amount of any profits on which it will be charged corporation tax is therefore a matter of considerable importance. The companies prepared their financial accounts in each of the years relevant to this appeal in accordance with an accounting standard called International Financial Reporting Standards. This standard is promulgated by the International Accounting Standards Board, and their standards are now widely used. While the standards are not themselves law, they are part of a body of generally accepted accountancy practice, which is recognized as important in various parts of our taxation law. The relevant standard for the present case was International Financial Reporting Standard 2, which I will shorten to IFRS 2. The purpose of IFRS 2 is to guide companies as to what entries to make in the different statements that make up the company's published annual accounts, to recognize the different elements in the transactions involved in operating this share option scheme. IFRS 2 required that the companies include an expense item on their income statements in respect of the grant of the share options. As it's impossible to value precisely how much of an employee's services were the result of them being incentivized by getting the options, IFRS 2 set the value of those services at the fair value of the options. So the expense to be included in the company's accounts was an amount which corresponded to the fair value of the options, and I'll call these expenses the debits. The principles of double-entry bookkeeping and accounting meant that the debits as an expense had to be matched by a corresponding credit that would be reflected in the company's balance sheets. As the share options came from the holding company issuing share options to the employees of its subsidiary companies, IFRS 2 required the companies to treat the corresponding credit in their balance sheets as a capital contribution from the holding company. The appellants, HMRC, accept that the companies have drawn up their financial accounts properly in accordance with IFRS 2, and they accept that the standard requires the inclusion of the debits as an expense in the company's profit and loss account. If that expense is then deducted from the profit made on which corporation tax is payable, the debits reduce the amount of tax the companies have to pay. But HMRC contend that the debits should not be treated as expenses within the company's income statements when it comes to calculating profits for the purpose of working out how much corporation tax they should pay. HMRC rely on various provisions of the Corporation Tax 2009, which they say have the effect that the companies are not allowed to deduct the debits from their profits, and the result of this is that the companies have not paid enough tax for the years in dispute. The first-tier tax tribunal, the upper tribunal, and the Court of Appeal have all rejected HMRC's arguments and held that the companies should deduct the debits from their profits for the purposes of corporation tax. Today, the Supreme Court unanimously upholds those decisions and dismisses HMRC's appeal. I will take each of HMRC's arguments in turn. The first issue concerns Section 46(1) of the Corporation Tax Act 2009. This says that a company's profits must be calculated in accordance with generally accepted accounting practice, but adds that this is, quote, subject to any adjustment required or authorised by law, unquote. So the question is there any such adjustment that means that the companies cannot rely on the debits to reduce their profits? The Supreme Court decides that there is not. HMRC rely in particular on a decision in the House of Lords in 1940 called Lowry against the Consolidated African Selection Trust, which they say does require or authorise a departure from IFRS 2. The Supreme Court rejects this argument. That earlier Lowry case was concerned with an earlier tax act, which had different wording from the statutory provision that we are considering in this appeal. The tax statute now gives primacy to generally accepted accounting practice as the way in which profits are calculated for tax purposes. HMRC argued further that although generally accepted accounting practices which are particularly directed at how the company draws up its profit and loss account have such primacy, here the IFRS 2 was more concerned with a different part of the company's annual financial statement, the balance sheet, and not the profit and loss account. HMRC argue that IFRS 2 was concerned with preserving the integrity of the balance sheet and that should not have the effect of reducing the company's profits. The Supreme Court considers there is no basis for such a distinction. A company's balance sheet and its profit and loss account are not separate and severable as HMRC suggest. Entries on one may affect entries on the other, in order that, overall, they give a true and fair view of the financial state of the company. The second issue was whether the deduction was disallowed by Section 54(1)A of the Corporation Tax Act. That states that no deduction should be made for, quote, expenses not incurred wholly and exclusively for the purposes of the trade, close quotes. HMRC contend that the debits were not really incurred because the company suffered no loss when giving them. The Supreme Court rejects that argument. Once something is to be treated as an expense within the statutory wording, it is deductible, and the fact that it is described in the statute as incurred does not import a further additional requirement. Section 54 is chiefly concerned with disallowing deductions for expenses incurred for a dual purpose and has no application to the question of how profits are to be calculated. The Supreme Court also rejects the argument that the debits were not for the purposes of trade within the meaning of Section 54. The first-tier tribunal made a finding of fact that the debits were incurred for such purposes, and no grounds for challenging that finding have been made out. The third issue was whether the deduction for the debits is disallowed by reason of Section 53 of the Act, which states that no deduction is allowed for items of a capital nature. HMRC rely on the fact that the credit corresponding to the debits on the company's balance sheets is treated by the accounting standard as a capital contribution received from the holding company and therefore is of a capital nature. HMRC contend that this must mean that the corresponding debits are also of a capital nature. The Supreme Court rejects this argument. The fact that the matching credit entry was treated as a capital contribution does not change the nature of the debits, and what matters is the character of the debits themselves. The fourth and final issue was whether the deduction for the debits was disallowed by Section 1290 of the Corporation Tax Act. That section places restrictions on deductions that would otherwise be allowable, where that deduction is a deduction in respect of what the legislation terms employee benefit contributions. This term is defined in Section 1291 of the Act, with the most relevant part of that definition for our purposes being a requirement that the property be held under an employee benefit scheme. The Supreme Court in the judgment analyses the definition of an employee benefit contribution and decides that what happens in this case does not involve property being held within the definition of the statute. so that provision does not apply to prevent the deduction. The Supreme Court therefore dismisses the appeal.
The Court will now adjourn.